When you think about banks, most people picture a place where you deposit your money, maybe take out a loan or open a new account. But have you ever wondered how exactly do banks make money? It's not like they're selling products on a shelf. They're offering a service, but that service is built on some of the oldest and most profitable tricks in the book. Banks don't just keep your money safe in a vault. They actively use it, invest it, and build an entire profit machine out of it. And the scale of it is huge. In this video, we're going to look in detail about how banks make money. Please do subscribe if you haven't already. It really helps this small channel grow. Let's start with the basics. When you deposit $1,000 into your bank account, that money doesn't just sit there waiting for you. Banks operate on something called fractional reserve banking, which means they only keep a fraction of deposits on hand and lend out the rest. If 100 people each put in $1,000, that's 100,000 in deposits. The bank might keep only $10,000 in reserve and loan out $90,000. That $90,000 could be used to fund mortgages, car loans, business loans, or credit cards. The people borrowing that money are paying interest, and that interest is the main way banks generate revenue. The spread between what they pay you for keeping your money in a savings account with them and what they charge borrowers is known as the net interest margin. Think of it this way. Maybe your savings account pays you 1% interest. But the bank takes that same money and gives out mortgages at 5% or credit cards at 20%. That difference is their profit. If they collect 5% on a mortgage but only pay you 1% for saving, they're making 4% on that loan. Scale that across billions of dollars and you start to see why banks are so powerful. Interest on loans is just one piece of the puzzle. Modern banks reach into every corner of finance. They charge fees for everything. Overdrafts, account maintenance, wire transfers, late payments, and currency exchanges. And those small fees add up massively. In the US alone, banks pull in billions each year from overdraft and penalty fees. In the UK, banks made more than $2 billion in overdraft fees in just a single year before reforms were brought in. These fees are often criticised as unfair, but they remain one of the most consistent revenue streams banks rely on. Then you have investment banking, which is a different game altogether. This is where banks like Goldman Sachs, Morgan Stanley, or Barclays make their fortunes by underwriting stocks and bonds, advising on mergers and acquisitions, and trading securities. When a company like Tesla wants to raise billions by issuing new shares, it's an investment bank that structures the deal, sells the shares, and takes a hefty commission in the process. It's the same with massive corporate mergers. When two multinationals decide to join together, banks sit in the middle, advising both sides and raking in fees. It's high stakes, high reward, and very profitable. Retail banks, the ones most of us interact with, also make plenty of money from credit cards. This is an area where profits can be insane. A credit card might charge you 20% or more on balances you don't pay off. On top of that, banks earn a small percentage every time you swipe, paid by the merchant. So even if you pay your balance on time, the bank still earns something from your transactions. Credit cards are basically cash cows disguised as convenience. There's also wealth management. If you're someone with a healthy bank balance or lots of investments, your bank might offer to manage your money. They'll invest it in mutual funds, retirement accounts, or structured products, and take a management fee for doing so. It might sound small, maybe 1% of your assets per year, but if you have millions, that's a nice earner for the bank, year after year. Another often overlooked profit stream comes from foreign exchange. If you've ever travelled abroad and exchanged pounds for euros or dollars or vice versa, you'll notice the rate at the bank or airport is never the same as the official market rate you see online. That gap, known as the spread, is pure profit. And because millions of people and businesses exchange currency every day, those tiny spreads generate billions globally. Now let's talk about one of the most profitable but sometimes invisible money-making tools that banks have, and that's trading. Many large banks have their own trading desks, where they buy and sell stocks, bonds, derivatives, and even commodities. Some of this trading is on behalf of clients, but often it's for the bank's own account. The idea is simple. Use their size, technology, and information advantage to make profitable trades. However, this has also landed banks in trouble in the past, especially when trades go wrong, like during the 2008 financial crisis. Still, for many institutions, trading remains a huge driver of profits. It's worth pointing out that banks also make money from governments. When governments issue bonds to raise money, banks are often the middlemen who underwrite and sell those bonds. They earn fees and interest in the process. In fact, governments rely on banks to keep their borrowing costs manageable, and banks profit nicely from being that middleman. So banks profit from lending, overdraft fees, credit cards, trading, investment banking, asset management, currency exchange, and government deals. But all of this hinges on one key thing, which is trust. Without people depositing money, without businesses borrowing, without investors seeking services, none of this works. That's why confidence in banks is so critical. When people panic and withdraw funds, like during the Northern Rock collapse in the UK, or the Lehman Brothers failure in the US, the entire system can collapse. Banks make their fortunes by balancing risk, managing deposits, and leveraging their size. But that also makes them vulnerable to shocks. Critics argue that banks sometimes take advantage of their position. When interest rates rise, they increase rates on mortgages and loans almost instantly, but take their time to raise the rates on savings accounts. You can see this yourself if you compare mortgage rates and savings rates next time your central bank lowers or raises its interest rate. The underlying business model of banks hasn't really changed for centuries. Take in money cheaply, lend out at a higher rate, charge fees along the way, and expand into every financial service possible. The packaging has changed, the technology has changed, but the core of how banks make money has stayed the same. And as long as people and businesses need a safe place to hold cash, access to loans, and financial services, banks will continue to be one of the most powerful money-making machines on the planet. And this is where things start to get really interesting for everyday people. Because once you understand how banks make money, you also start to see how you're positioned within that system. Your savings, your mortgage, your credit card balance, all of it feeds into this machine. Banks are incredibly good at making money from small margins, repeated over and over across millions of customers. Individually, the amounts feel tiny. A few dollars here in fees, a slightly worse interest rate there, but collectively it's huge. This is also why low-cost alternatives have started gaining traction. Online banks, fintech apps, and index investing all try to strip away some of those fees and spreads. They don't replace the current system entirely, but they do challenge some parts of it. Still, banks remain dominant because they offer convenience, perceived safety, and scale that's hard to compete with. Understanding this doesn't mean all banks are evil, but it does mean you're better equipped to make smarter financial decisions, avoid unnecessary fees, and keep more of your own money working for you instead of for them. Do you think banks use their powerful position unfairly, and should they face tighter regulation? Let me know down in the comments, and please do subscribe if you've enjoyed this video, and thanks for watching.